The Pacific Northwest once represented the picture-perfect version of the American dream, filled with towering evergreen forests, thriving tech economies, and cities that seemed unstoppable. Now, as 2026 moves forward, I'm watching the housing market across this once booming region unravel at an alarming pace right in front of me. I've spent countless hours digging through property listings, foreclosure records, zoning meetings, and local market data trying to uncover what exactly caused things to spiral so badly. Across the region, people are leaving in huge numbers, abandoning homes behind while property values continue sinking fast. The warning signs had been flashing for months, like bright neon lights, yet countless everyday buyers still ended up purchasing at the absolute peak of the frenzy and are now paying the price for it. If you enjoy this kind of in-depth breakdown, take a second to subscribe to the channel and send this video to someone who should probably hear this information too. Now let me walk you through the evidence I uncovered showing exactly where this Pacific Northwest real estate meltdown is hitting the hardest. Number 10. Boise. I can still remember when this high desert city became the favorite destination for remote workers fleeing outrageously expensive coastal markets. Back then, Boise was being sold as the perfect escape hatch. But from everything I've uncovered, that dream lifestyle came to a sudden and painful end. Driving through the newer subdivisions spreading across the outskirts of town now feels eerie, almost like wandering through neighborhoods built for people who never actually arrived. Entire streets of freshly constructed homes are sitting silent and empty, turning what was once a booming expansion into something that resembles a ghost town filled with broken expectations. According to recent figures from the local real estate board, active housing inventory has exploded by roughly 85% compared to where it stood just 2 years ago. That kind of jump is impossible to ignore. Everywhere you look, newly built spec homes are sitting untouched while nervous builders wait anxiously for buyers who simply are not showing up anymore. The latest numbers from Redfin paint an even uglier picture. Over the past year alone, the median home price has fallen by around 12%. Imagine purchasing a home for $800,000, only to watch nearly $100,000 in value disappear before you've even had time to fully settle in or unpack your boxes. That nightmare became reality for thousands of newcomers who genuinely believed the housing boom would continue forever. Meanwhile, longtime locals who were pushed out of the neighborhoods they grew up in are now watching many of those same transplants rush to sell before prices slide even further. There's a certain bitterness in seeing that entire cycle play out. The slowdown is becoming impossible to hide. Realtor data now shows the average home is sitting on the market for about 62 days, which is a dramatic shift from the frenzy years when properties were disappearing in barely over a week. At the peak, homes were selling in around 8 days flat. Now sellers are stuck waiting month after month with little interest coming in. Many homeowners have become so desperate to close deals that they are throwing in major incentives just to attract attention. I reviewed local MLS reports showing that nearly 40% of recent transactions included sellers covering closing costs for buyers just to keep the deals alive. The whole situation feels less like a healthy housing market and more like a liquidation sale at a struggling department store trying to survive one last season. On top of that, the economic foundation supporting those inflated prices is starting to weaken. Regional labor statistics reveal that local tech employment has already declined by about 2%, which may sound small at first, but it removes the very salaries that helped justify these sky-high home values to begin with. At the end of the day, it is incredibly difficult to maintain coastal-level housing prices in a state where wages simply do not support them, no matter how attractive the mountain views and outdoor lifestyle may be. For a city that once believed it had discovered the secret formula for endless real estate appreciation, this has turned into a brutal reality check. Number 9. Spokane. Once I made my way to the eastern side of Washington state, I found a housing situation that honestly feels heartbreaking for ordinary working families who believed they were buying into stability and affordability. For years, Spokane was viewed as the cheaper alternative to the overcrowded and overpriced coastal cities. People saw it as a safe place to settle down, raise families, and escape the financial madness happening in larger metro areas. But the speculative housing frenzy completely distorted the local market and pushed the city far beyond what local incomes could realistically support. When I reviewed the latest regional affordability data, the numbers were deeply alarming. Roughly 65% of local residents now earn less than the income needed to purchase a median-priced home in the area. Think about how unsustainable that really is. When teachers, firefighters, nurses, and other essential workers can no longer afford to live in the communities they serve, something has gone seriously wrong. The damage is becoming visible in almost every corner of the market. Zillow recently reported that nearly 45% of all active listings experienced price reductions just within the last month alone. Sellers are slashing prices again and again, desperately trying to attract buyers in a market that suddenly lost momentum. I keep seeing gorgeous historic homes, carefully renovated and professionally staged, sitting untouched for weeks or even months. When you scroll through the listing histories, the repeated price cuts look like a staircase dropping lower and lower toward the basement. Behind the scenes, local title companies are quietly handling a growing wave of financial distress. According to data from Atom Data Solutions, pre-foreclosure filings jumped by around 28% during the first quarter of this year. And behind every one of those filings is a real family sitting around a kitchen table trying to figure out how they're going to hold on to their home. That's the human side of these market crashes people rarely talk about. The speculation machine inflated prices beyond reason, pulled families into the frenzy, and is now leaving many of them trapped on the way down. Even the rental market is no longer offering much relief. Apartment association figures show local vacancy rates climbing to roughly 7%, a massive shift from the extremely tight 2% vacancy levels the city had only a few years ago. Landlords are getting nervous fast. Many are now offering incentives like 2 months of free rent just to secure tenants before conditions deteriorate further. I've spoken with several property managers who are genuinely worried about the wave of new apartment developments still under construction, because even more empty units are about to hit an already weakening market. At a certain point, the math simply stops working. When local wages cannot keep up with exploding housing costs and rising rents, the entire system becomes unstable. What was once considered a peaceful Eastern Washington refuge has now turned into a painful financial trap for buyers who entered the market at the absolute height of the chaos. Number 8. Eugene. This offbeat college town has always had its own personality and rhythm, proudly doing things differently from the rest of the country. But these days, the mood here feels far less optimistic. The soundtrack playing across Eugene right now sounds more like the slow collapse of a housing market that got way too overheated. I came into town expecting to find at least a few signs that the market was stabilizing. Instead, I found neighborhoods flooded with overpriced homes sitting idle because hardly anyone can realistically afford them anymore. After digging through county property records this week, I discovered that permits for new single-family home construction have absolutely fallen off a cliff, dropping roughly 52% compared to last year. Builders have clearly slammed on the brakes because they understand the buyer pool has dried up dramatically. There simply are not enough qualified buyers left to absorb all this inventory. What's especially striking is how much denial still exists in the market. Despite everything happening, many sellers continue pricing homes as if it were still the height of the pandemic housing mania. CoreLogic recently released an analysis showing that home sales volume has collapsed by around 34% when compared to long-term historical averages. In plain English, very few people are moving right now, unless life forces them into it through situations like divorce, layoffs, or financial pressure. And yet, some homeowners are still trying to list outdated properties at absolutely absurd prices. It's honestly hard not to laugh when you see a damp old bungalow needing major repairs and a brand new roof somehow listed for $700,000 as if buyers are supposed to ignore reality. The weakness in the student housing market is also starting to spill into surrounding residential neighborhoods. According to a recent report from the University Housing Authority, off-campus rental prices have already fallen by roughly 8%. That drop is putting enormous pressure on small investors who bought rental homes expecting endless demand and ever-rising rents. Now many of those so-called mom-and-pop landlords are struggling to cover oversized mortgage payments they took on during the boom years. And when even college students cannot afford the rent you're charging, it becomes painfully obvious that the entire investment strategy was built on unrealistic assumptions. Imagine taking out a huge loan on an investment property believing the rental income would easily cover everything, only to realize later that the numbers never truly made sense in the first place. The amount of time homes are sitting unsold has also become staggering. Regional housing data now shows the median property is lingering on the market for around 75 days, which feels like an eternity in real estate terms. Sellers are trying everything imaginable to attract buyers. They're hosting endless open houses, staging homes to perfection, baking cookies for visitors, and practically begging for offers. But instead of bidding wars, they're mostly being met with silence. And honestly, it's difficult not to feel sympathy for the people who bought at peak prices hoping they were building a future here, only to watch their neighborhoods slowly turn into pools of stagnant inventory and declining property values. Number 7. Tacoma. For a long time, this blue-collar port city marketed itself as the more affordable and slightly calmer alternative to the massive tech-driven chaos further north. People who couldn't handle the prices in Seattle started looking toward Tacoma as the next opportunity. But after following the money and digging into the numbers, what I found was a secondary housing market getting absolutely hammered by rising interest rates and collapsing affordability. The latest report from the local Chamber of Commerce paints a grim picture. Roughly 38% of homeowners with mortgages are now considered house poor, meaning they're spending far beyond the recommended share of their income just to keep up with housing payments. That statistic alone says a lot about how dangerous things have become. Families are stretched so thin financially that something as ordinary as a major car repair or unexpected medical bill could push them straight into default or foreclosure. The market itself is already showing clear signs of stress. According to Redfin data, the median pending sale price in Tacoma dropped by around 9.5% in just a single quarter. That's not a gentle correction anymore. That's a sharp and painful reversal. Many buyers were sold on the idea that Tacoma would become the perfect commuter refuge for workers tied to the Seattle economy. But now, with borrowing costs surging and remote work becoming less predictable, that entire narrative is starting to crack apart. As I drove through different neighborhoods, I passed countless flipped homes sitting empty for weeks on end. You can spot them instantly: gray luxury vinyl floors, quick cosmetic renovations, trendy finishes clearly designed for resale profits. But now, those same properties are collecting dust while investors bleed money through carrying costs every month they fail to sell. The investor pullback is becoming impossible to ignore. An analysis from the State Department of Revenue revealed a 15% spike in real estate excise tax transactions tied largely to corporate investors unloading single-family homes from their portfolios. In other words, many of the same investors who flooded into these neighborhoods during the boom are now rushing for the exits before prices fall further. They're cutting losses, cashing out, and leaving local communities stuck dealing with the aftermath. It follows a pattern we've seen before. Investors pile into working-class neighborhoods, drive prices beyond what locals can reasonably afford, profit from the hype cycle, and then disappear once the market turns south. Unfortunately, the residents who actually live there are the ones left carrying the financial burden. Inventory numbers are also exploding. The Regional Housing Alliance recently reported that unsold residential listings have surged by roughly 90% compared to the extreme lows seen during the peak housing frenzy. And there's simply no way to dump that much inventory into a cooling market without triggering major downward pressure on prices. I'm watching sellers slash prices week after week, sometimes dropping another $10,000, almost like clockwork, just trying to attract any serious buyer. The problem is that every time they think they've found the bottom, the market slips even lower underneath them. What was once promoted as a stable working-class haven for building long-term wealth is now starting to resemble financial quicksand for many homeowners trying to stay afloat. Number 6. Bend. This mountain town built its entire identity around craft breweries, outdoor adventure, luxury cabins, and a non-stop stream of wealthy out-of-state buyers willing to pay cash for second homes and vacation properties. For years, Bend looked unstoppable. But after digging into the numbers behind this high-desert housing market, the situation now looks deeply unstable. At the height of the boom, the city almost transformed into a private resort community for affluent remote workers and investors. The problem is that many of those buyers are no longer showing up, and the entire system is beginning to crack under its own weight. Recent data from the local Economic Development Bureau revealed that hospitality and leisure tax revenues dropped by roughly 14% this year. That decline is a major warning sign because tourism and vacation spending were helping fuel the housing frenzy in the first place. Once that engine slows down, the rest of the market starts wobbling too. What's really catching my attention is how aggressively sellers are now being forced to cut prices. Zillow metrics show that nearly 60% of active listings in the area have already reduced their asking price at least once after hitting the market. I'm seeing massive custom-built mountain homes originally listed for around $1.5 million sitting untouched for months before sellers finally slash prices by hundreds of thousands of dollars just to attract a single serious buyer. There's something almost surreal about watching speculators who assumed endless appreciation suddenly realize that buyers are no longer willing to overpay for luxury cabins tucked away in the forest. The short-term rental market is also taking a serious hit. City Council records indicate that active short-term rental permits have fallen by approximately 22% as travelers cut back on discretionary spending and grow tired of sky-high nightly rates and outrageous cleaning fees. A lot of small investors built their entire financial strategy around the idea that vacation rentals would permanently generate easy income to cover oversized mortgages. Now many of those same owners are scrambling to stay afloat as bookings slow down and expenses pile up. And honestly, one of the saddest parts of this whole story is what happened to local service workers. Many longtime residents were pushed out of rental housing because landlords realized they could make more money catering to tourists. Now some of those same landlords are facing financial collapse themselves after overextending during the boom. Meanwhile, inventory levels are climbing rapidly. Local MLS data shows housing supply has now reached around 6.5 months, officially shifting Bend into strong buyer market territory. That's an enormous reversal from the frenzy years when homes were selling in barely 4 days with multiple offers flying in immediately. A huge portion of this bubble was driven by remote workers with high salaries who believed they could live in vacation towns forever while working from home indefinitely. But now, many companies are calling employees back to the office, forcing homeowners to unload their so-called dream lifestyle properties at significant losses. What once looked like the ultimate outdoor paradise has increasingly turned into a financial disaster zone for investors who arrived late and bought near the absolute top of the market. Number 5. Meridian. During the massive relocation wave of the past few years, this quiet suburban city transformed into a magnet for wealthy newcomers, political transplants, and remote workers looking for space, safety, and luxury living away from crowded coastal states. For a while, Meridian was treated like the ultimate success story. But after digging into the market data, it's becoming clear that the boom created a financial imbalance the town was never built to sustain. The flood of money that poured into this community happened so quickly and on such an extreme scale that the correction now unfolding feels especially brutal. A recent housing report from Realtor.com showed active inventory exploding by an astonishing 115% over the past year alone. That kind of surge tells you one thing immediately. Far too many people are trying to sell at the same time while demand dries up underneath them. Now the market is clogged with expensive homes and oversized estates, sitting unsold as sellers compete desperately for shrinking buyer interest. But the real issue goes much deeper than inventory. The biggest problem here is the enormous disconnect between local incomes and housing prices. State Labor Department figures show the median household income in Meridian sits around $65,000 per year. Meanwhile, the median home price remains close to $750,000. That math simply does not work. Imagine being a teacher, nurse, firefighter, or other working professional trying to survive in a town where home prices climbed so far beyond local wages that ownership became nearly impossible for longtime residents. What makes the situation especially sad is that many local families were pushed aside during the frenzy as speculative money flooded into the market. Now, after all that disruption, the same inflated market that displaced them is beginning to collapse under its own weight. Many sellers are finally learning that beautiful mountain scenery and luxury finishes cannot magically justify prices buyers can no longer afford. According to data from the Regional Real Estate Association, median sale prices have already fallen roughly 13.5% from their peak levels. And the declines are becoming harder to ignore with every passing month. I'm following listings for stunning high-end homes that have now been sitting untouched for more than 200 days. In many cases, owners refuse to believe the enormous paper wealth they gained during the boom was temporary, and now they're stuck chasing the market downward. The construction industry is also slamming into a wall. County planning data shows new subdivision applications have collapsed by around 70%, which signals that developers themselves are losing confidence in the future demand story. I recently walked through a partially completed luxury subdivision where construction equipment sat abandoned and motionless, with projects stalled before completion. It felt like a physical reminder of how quickly easy money can disappear. Once the stream of out-of-state cash slowed down, it exposed how fragile the local economy had become beneath the surface. What's left now is a community trying to recover after an artificial boom inflated housing prices far beyond what the area could realistically support long-term. Number 4. Salem. As the state capital, this city has traditionally been seen as a steady and relatively safe place to ride out economic turbulence, largely because of the stability provided by government employment. But the housing data I'm seeing right now tells a very different story, one that looks increasingly unstable and financially strained. What's unfolding here is a market under heavy pressure from rising property taxes combined with stagnant wages across much of the public sector. That combination is proving especially difficult for households that don't have much financial flexibility. Recent municipal revenue reports show property tax assessments rising by an average of about 8% this year. On paper, that may not sound extreme, but for families already living paycheck to paycheck, it creates a serious financial squeeze that many simply cannot absorb. As a result, the affordability crisis is now spilling directly into the housing market. I'm seeing a noticeable wave of distressed listings as more homeowners are forced to sell under pressure rather than choice. A recent CoreLogic analysis also shows that the share of homes slipping into negative equity has increased by roughly 14% over the past 2 quarters. That's a particularly painful indicator because it means more owners now owe more on their mortgages than their homes are actually worth. For many families who bought starter homes with the hope of building stability and long-term security, this is turning into a worst-case scenario. Instead of growing equity, they are watching their financial position erode while debt effectively overtakes their investment. What stands out most is how widespread the price reductions have become. Data from the local MLS suggests that nearly half of all active listings have already undergone at least one price cut, often by $5,000 or more, as sellers try to stay competitive in a weakening market. Driving through several middle-class neighborhoods, the signs of strain are easy to spot. For sale signs are fading under the sun, lawns are becoming overgrown, and more homeowners seem to be quietly stepping away from listings that aren't moving. There's a growing sense of frustration among sellers who feel forced to accept lower offers while still stuck with high mortgage payments. Many are essentially begging the market for relief that isn't coming fast enough. At the same time, new construction in the surrounding suburbs is adding even more pressure. The local Builders Association reports an 18% rise in completed homes that remain unsold, creating a surplus of brand-new properties with no immediate buyers. These developments, often identical and mass-produced, are starting to resemble modern-day ghost neighborhoods, streets filled with empty houses waiting for demand that isn't keeping pace. To attract buyers, builders are now offering aggressive incentives, including major interest rate buy-downs and tens of thousands of dollars in concessions just to close deals. When even a traditionally stable state capital begins relying on panic-driven discounts and heavy incentives to move inventory, it becomes a clear signal that the entire regional housing foundation is under serious strain. Number 3. Vancouver. Located just across the river from a major metropolitan area, this suburban city was widely promoted as a convenient escape hatch, a place where buyers could enjoy lower costs while avoiding certain state taxes. For a while, it attracted a huge wave of relocation-driven demand. But after digging into the data, what I'm seeing now is a dramatic reversal that looks far less like a success story and much more like a market unwind. A large influx of people moved across the state line chasing tax advantages and cheaper housing, but that rapid migration ended up overwhelming local affordability instead of improving it. Now the momentum has completely shifted, and the aftermath is becoming painfully clear. According to regional housing data from Redfin, the median days on market has surged by about 110% year over year. That means homes that once sold quickly are now sitting for extended periods, turning into a slow, drawn-out process with no urgency from buyers. Sellers are increasingly stuck in limbo. Many are repeatedly lowering their asking prices, in some cases cutting $25,000 or more month after month, as they try to find a floor in a market that keeps sliding downward. What stands out most is the growing sense of panic among investors who once believed this border community was a guaranteed winner, almost like a perpetual cash-generating market. That confidence has clearly faded. Employment data from the state's Job Security Department shows local job growth has essentially stalled, sitting at around 0.2%. In practical terms, that means there's very little new income entering the market to support previously inflated home values. At the same time, the rental sector is also weakening. A report from the Regional Apartment Association indicates vacancy rates have climbed past 8.5%, which puts significant pressure on landlords who were relying on steady rental demand. Many so-called accidental landlords, people who bought homes expecting to rent them out for easy income, are now facing a very different reality. With empty units and rising mortgage payments, they're stuck covering large monthly losses while waiting for tenants who aren't arriving. It's not hard to imagine the stress behind it. Someone who put their life savings into a rental property, expecting consistent cash flow, now sitting in an empty home unable to secure a tenant while expenses keep piling up. Distress signals are also showing up in foreclosure-related data. Atom Data Solutions reports a roughly 31% rise in default notices issued by banks over the past 6 months, signaling increasing financial strain across the market. And this isn't limited to high-risk investors or speculative flippers. Many of the people getting caught in this downturn are ordinary working families who entered the market during the buying frenzy and simply took on too much debt at the wrong time. What was once marketed as a stable, tax-friendly alternative has now turned into a housing trap for many residents, leaving thousands with underwater mortgages and very limited options for escape as the market continues to weaken. Number 2. Portland. This once famous hipster hub has increasingly become a case study in how quickly an urban housing market can deteriorate under sustained pressure. After digging through the local real estate data, what stands out isn't just weakness. It's a broader unraveling that's affecting both prices and confidence across the entire metro area. The population shift is no longer just a talking point or media narrative. It's showing up clearly in the numbers. Recent domestic migration data from the U.S. Census Bureau indicates the region lost more than 14,000 residents in a single year. That kind of outflow matters because when people leave at scale, they take income, demand, and long-term housing support with them. As the tax base shrinks and households relocate elsewhere, the housing market naturally starts to weaken in response. And that's exactly what's happening here. The downtown condominium sector is taking a particularly hard hit. Market data from Zillow shows urban condo prices have dropped by around 24% from their peak, marking one of the steepest corrections in the area. I'm seeing high-end Riverview units, properties that once commanded premium prices, now selling at significant losses. Many buyers are pulling back due to concerns about neighborhood conditions, rising costs, and unpredictable property taxes, all of which are eroding confidence in urban living. It's frustrating to watch a city with such cultural energy and identity experience a decline in its core real estate market to the point where many properties are effectively treated as high-risk assets rather than desirable homes. And the pressure isn't limited to downtown. Even traditionally stable suburban areas are feeling the impact. Regional MLS data shows total housing inventory across the metro area has surged by roughly 76%, flooding the market with listings while buyer demand continues to shrink. High interest rates combined with rising local tax burdens have pushed many buyers to the sidelines entirely. At the same time, homeowners are left carrying steep carrying costs while watching their equity shrink month after month. The strain is also spilling over from commercial real estate. A weakening downtown office market is feeding into residential demand problems. According to the local Chamber of Commerce, office vacancy rates have climbed to a record 30%. As office buildings sit empty, nearby businesses like cafes and restaurants struggle to survive, which in turn makes surrounding neighborhoods less attractive for residents and potential buyers. It creates a ripple effect that drags down the entire urban ecosystem. I've spoken with families who feel completely stuck, underwater on their mortgages, unable to sell without taking massive losses, and effectively locked into properties they can't afford to exit. This city once embraced its reputation for being unconventional and unique. But right now, the most striking thing isn't its personality. It's how quickly a once expensive and highly sought-after housing market can lose value and stability when multiple pressures collide at once. Number 1. Seattle. The Emerald City used to stand as the undisputed centerpiece of the coastal tech boom, the place everyone pointed to when talking about unstoppable growth, soaring salaries, and endless real estate appreciation. But what I'm looking at now feels completely different. It's a full-scale correction unfolding in real time, and its impact is likely to be felt for years. A wave of aggressive job cuts from major tech companies has started to ripple through the entire housing market. That corporate downsizing is directly feeding into fear, uncertainty, and a sharp slowdown in residential demand. When I dug into regional economic reports and workforce data, I found that more than 22,000 high-paying tech jobs have disappeared from the metro area over the last 18 months alone. Once that level of income leaves the system, everything tied to it starts to shift fast. Homes that once sold easily at million-dollar price points suddenly stop feeling like assets and start behaving more like financial liabilities. The price data confirms the turning point. According to the Northwest Multiple Listing Service, median home prices within the city have fallen by roughly 14.5% year over year. That's a significant drop for a market that many believed would stay permanently elevated. I've been tracking individual cases that really highlight the shift. Tech workers who bought relatively modest three-bedroom homes for around $1.2 million are now watching $200,000 or more in paper value disappear in what feels like a very short period of time. The sense of stability that once came with those purchases has clearly eroded. At the same time, the luxury segment is under heavy pressure. New policy changes, including increased taxes on high-end properties, have added another layer of strain. Data from the county assessor shows that sales of homes priced above $2 million have dropped by about 46%, as wealthy buyers either step back or move elsewhere entirely. Many high-net-worth buyers are now choosing to relocate across the water or leave the state altogether, rather than absorb higher costs and taxes. And this is where a hard truth becomes clear. You can't rely on taxation or policy shifts alone to keep a housing market inflated indefinitely. As demand weakens, inventory is being pushed into the rental market out of necessity. A recent Redfin analysis shows local rents have declined by about 6.5%, largely because thousands of unsold homes are being converted into rental properties just to generate some form of cash flow. That shift creates its own pressure loop, as rising rental supply pushes prices down even further. What stands out most in all of this is the human impact underneath the numbers. Longtime residents who weathered years of rising costs are now watching the same system unwind, often leaving them with reduced equity or homes that are worth far less than expected. The broader picture is clear. A region that once symbolized unstoppable growth has turned into a cautionary example of what happens when expectations outpace economic reality. Communities built on the assumption of endless appreciation are now dealing with the consequences of that belief fading away. And for many everyday homeowners, the result is a difficult adjustment, trying to make sense of lost value, shifting markets, and a future that no longer looks as predictable as it once did.